Hi, my name is Jay Abalafi. I'm the founder of Lion Financial Planning. Today I want to walk through my economic and financial planning assumptions that I use with clients in constructing their comprehensive financial plan. So in 2020, the assumptions that I'm using for plans are as follows. I assume that you live through the age of 100. This is based on actuarial and mortality data that suggests that people have a much higher probability than they might believe of living well into their 90s. Rates of return in your financial plan. So for the base scenario in your plan, I'm going to use a very conservative real or inflation adjusted rate of return of about 1%. That is that all of the financial assets in your plan are going to grow year over year at 1% above inflation. For this estimate, I use a 10-year historical average for the 30-year, for the rates on 30-year U.S. Treasury inflation protected bonds. For inflation, I'm going to assume a rate of around 2%. This year it's 2.12%. This is based on the 10-year average of the US break-even inflation rate, which is a market-based projection for long-run inflation. For housing, the first assumption is that unless we plan for a move or a change or a downsize, we're going to assume that you maintain your home for life, and therefore it's going to be gifted or left to your heirs at the end of your life. Secondly, the plan is going to account for kind of a long-run average estimate for any major home maintenance expenses in your plan. And the way that I account for this is I assume that 2% is a representative or weighted average depreciation rate for all of the major structural components of your home. And so we're going to assume that every year you have an expense of 2% of the dwelling's estimated replacement cost. The 2% is based on internal research that I myself have done, looking at the kind of typical costs for a representative home over a long period of time. And secondly, to get the dwelling replacement cost, I'm going to look at the coverage A, or the dwelling coverage, directly on your homeowner's policy. Lastly, we're going to assume a very conservative real appreciation or inflation adjusted rate of return on real estate of about 0.44%. This is based on a very long run data series provided by Professor Robert Shiller that looks at US housing prices since 1890. Social Security. So Social Security, as many people know, something has to give, and that is likely to result in some combination of tax increases and benefit cuts. So based on data directly from the Board of Trustees of the Social Security Trust Funds, I make assumptions that payroll taxes for Social Security are going to increase by about 2 percentage points. And benefits are going to decrease for all Social Security beneficiaries by 12.5% in 2035. And this is based, as I said before, directly on data from the Social Security Administration that estimates how large of a payroll tax increase and or benefit cut would be necessary to close the long-run financial or funding gap of the Social Security program. Lastly is Medicare. So similar to Social Security, Medicare also is in financial trouble. Something has to give. So in the plan, again, based on data from the Board of Trustees of the Medicare Trust Funds, I assume that Medicare Part A payroll taxes are going to increase by about 0.76 percentage points. This is based on, again, estimates by the Board of Trustees that assumes that payroll taxes have to increase by this much to close the long-run funding gap for Part A expenditures, that is hospital insurance. Part B, I assume that those premiums for Medicare Part B are going to increase at about 3% above inflation. This is also based on direct estimates of the real growth of future Part B premiums by the Board of Trustees. And lastly, we're going to account for an estimate of Medigap, that's Medicare Supplement, and Part D premiums, that's drug premiums, of about $4,000 per person from age 65 onward.